Last month in September, the Straits Times posted an article. Straits Times Index STI hit 17-year high as regional indexes post mixed results. And this was for the market on 23rd September 2024, when STI just hit a new high after so many years. In fact, if we look at the following day, 24th September, STI actually hit like 3,600 over points based on the Yahoo Finance chart right here. For comparison, the last STI high was in the year of 2007, where it went up to 3,905 points in October 2007. And after that, the global financial crisis just happened, and the STI has never recovered to the past glory after that. So what has led to the recent uptrend of the Straits Times Index? We shall discuss more in this video. Meanwhile, if you want to join like-minded people interested in building their wealth and personal finance and investing for the future, join us at over 17,000 members in the Honey Money SG Telegram group. If you watch enough YouTube, you know that Mr. Lu from 1965 channel calls STI a super terrible index. While he may be right for the past few years, but if you look at the current trends and the current sentiments, is it really terrible though? First of all, if you're really new to investing and you don't even know what the STI means, it means the Straits Times Index. And what does it comprise of? It is a market capitalization weighted index that tracks the performance of the top 30 companies listed on SGX. And if we take a look at the constituents, it is made out of mostly the top 3 banks of Singapore as well as the real estate investment trust, or commonly known as REITs. Now, why people really love to invest in STI is really quite simple. Number one, it's made out of many dividend-paying companies, which means that if you're investing for dividend income, you just want to receive cash flow quarter after quarter, then investing STI may be a very good choice because dividends are not taxed in Singapore. So whatever the company pays out as dividends, you will receive as net income. And I guess most people, when they start out with investing, they want to start with something that they are familiar with, something that they use and visit in real life. For example, you visit the bank, right? You visit the malls, right? You will know what these companies are doing. For example, you want to compare DBS versus JP Morgan. JP Morgan is a very large US bank and in fact one of the largest banks in the world compared to DBS, but people are just more comfortable with DBS because they see it every day. So coming back to the main topic, what are the main drivers that is driving up the uptrend of the STI? If we look at the top 3 banks' share price year to date, DBS Bank, ticker D05, actually hit a new high of $39 over a share, which means more than 20% year to date performance return. Then for the other 2 banks, UOB and OCBC, they also recorded around a 20% year-to-date gain. When the Fed announced the interest rate cut of 50 basis points on the 18th September, Singapore REITs just got carried by the wave, right? Because as you know, as interest rate cut, it is more beneficial for the REITs to loan the money, which means it is cheaper on the interest expense, and that means the company can earn more profit. Now, to be clear, the savings does not come immediately. It's just that stock market is forward-looking. That's why people are generally more positive. So if you look at one of the big REITs, Mapletree Industrial Trust, shot past $2.50. It has stayed below $2.50 for a long time, recently just shot back up. Then if we look at the largest integrated retail REIT, CICT, Capital Land Integrated Commercial Trust, it also shot past $2.10. So you see, if you're an investor and you're holding on to either Singapore banks or Singapore REITs, you'll be a very happy person after 18th of September when the Fed announced the interest rate cut. Firstly, you'll be happy with more capital appreciation from your stocks. And secondly, you can continue to enjoy your dividend income flowing in quarter after quarter. In fact, if you look at the current dividend yield for DBS, even if you're buying around the $38 price range, based on Moomoo app, you're getting around 5% per annum dividend yield, and that's because DBS is a very good dividend payer. Now, 5% per annum dividends is considered pretty good already, and you should know by now that interest rates and low yield return products, the yield is already falling. Most of it are around 3% or even lower now. But do you know that you can still get 6.8% per annum on your idle cash with Moomoo Cash Plus, which is invested in money market funds and at the same time give you the best competitive pricing for Singapore markets? And that is from the sponsor of today, Moomoo Singapore. Do you know that you can now transfer in SGX shares from CDP account to Moomoo SG custodian account? And here are 3 reasons why you should transfer to Moomoo SG. Number 1, lower trading fees. Trading fees at Moomoo is at 0.03% or 99 SG cents per order, with no dividend charges or corporate action charges, while outside brokers may charge a minimum of 10 Singapore dollars for CDP accounts. Number 2, easy transfer. Transferring SGX holdings from CDP or other brokers to Moomoo SG is now completely online and can be done via the app. You can do so by going to Accounts, Transfers, transfer stock in SG market, and select where you are transferring from. And number 3, reliable custody. Moomoo SG is licensed and regulated by MAS and is the first digital broker to receive SGX Group's full memberships across securities and derivatives markets. Furthermore, there is a transfer in promotion even for existing customers, where if you initiate a one-time transfer stock value of at least 10,000 Singapore dollars, you can receive 100 Singapore dollars of stock cash coupon. And even at the highest tier, you can get a brand new iPhone 16, limited to the first 60 eligible customers. For new Moomoo users who use my exclusive link to sign up, you can enjoy 30 days of 6.8% per annum guaranteed return promo worth up to 447 Singapore dollars. But as a disclaimer, please note that Moomoo Cash Plus is an investment product. This is not comparable and is different from savings deposits. Principal is not guaranteed, and up to 30 days of 6.8% per annum is guaranteed only during the promotional period. Furthermore, you will be able to unlock up to 4 stock bundles of the top 5 traded US stocks worth 70 Singapore dollars each, and 1 Apple share worth around 287 Singapore dollars. Sign up with my exclusive link for a bonus 20 Singapore dollars cash coupon. That's a total rewards value of 1,034 Singapore dollars. Holding period and buy trade applies. Investment in any capital market products involves risk and the risk to lose capital. For more details of the promotions, please refer to the link landing page in the description below. So wait no more and use my exclusive link or scan the QR code right here to get your Moomoo SG Universal account today. Now, another reason why some people prefer to invest in Singapore markets is because of the foreign currency risk. Now, what do I mean by foreign currency risk? For example, if you look at the USD to SGD exchange rate, at the earlier part of the year in April 2024, it was giving 1.36 SGD per USD. But as of early October 2024, the exchange rate has dropped to 1.28. Now, if you don't know the impact, let me calculate for you, right? So if you take 1.28 divided by 1.36, you get around 6%. 6% drop leh. You know, sometimes the market don't even increase 6% in 1 year. And then now, even if the market stays stable and flat, you're losing 6% on foreign currency. So let's say if you have invested in some US stocks or ETFs, even if they maintain price, but in net effect is you still lost because of the foreign currency. And I surely know that some people cannot accept this kind of risk, especially if they place US dollars in fixed deposits. They will feel even more pain because their interest rate is already capped, but you see the foreign currency loss is still ongoing. So for the Singapore markets STI, is it a short-term rally or is it a long-term positive outcome? We don't really know yet. All I know is that based on past history, it has remained underperforming compared to other regional markets, not even the US. But who knows, maybe the trend would change. How I see the Singapore markets now is that it's just starting to recover from the lows of COVID for the past few years. So after I talk so much, you may have some second thoughts on whether to invest in Singapore markets. I shall share who is STI most suitable for. Firstly, it's suitable for investors who prefer a dividend income approach rather than a growth approach. What it means is that they prefer to invest in cash flow because all these dividend paying companies, every quarter or every half a year, they will pay you dividends out of their own profits. So it's really quite suitable for retirees who need a consistent income coming from all this cash flow to supplement their daily lifestyle expenses. And it's really good for those people who prefer a lower volatility because the matter of fact is Singapore stocks and Singapore markets, they have less fluctuation compared to what you're seeing in the US stock market where it's really heavily high or heavily low, and you know it fluctuates along with the Fed news. So if you don't like huge fluctuation then can consider STI. Lastly, it's more focused on capital preservation rather than capital growth. So it's suitable when you are in the late years, retiree years, you're older, you want to preserve capital. You don't need to grow until very fast, but you just want to make sure this money don't keep go high, don't keep go low. Very bad for financial planning in your retirement years. So the conclusion of this video is that I'm not going to discuss whether dividends are relevant or not, because that is going to come up to a lot of separate debate. I just want to highlight that your profit and loss, whether unrealized or realized, can come in the form of capital appreciation or dividend gains. Or it could be a mix of both, right? Especially if you see DBS stock give like 5% per annum dividend and still can grow some capital appreciation. So you should go for your own preferred choice, no right or wrong. In fact, I think that there are some younger folks who are into dividend investing as well. And there's really nothing wrong with it. It's just a personal preference. Now, I do have some dividend stocks with STI based on my legacy positions, but fundamentally, most of my majority positions are still in the US indices, especially the S&P 500. And the main reason is because I follow a more passive approach towards investing, which means I want to dollar cost average or lump sum when I have the money and I don't need the dividends yet. I'm not in my retirement years and I want it to grow capital over time without me interfering much. So that's my own personal approach. Doesn't mean it's right for you. You have to find what is the right approach for yourself. Anyway, do know that whatever I mentioned in this video, whether they are stock tickers or not, it's not financial advice. It's just an example. It's for illustration only. So do your own research. But ultimately, I do hope that Singapore market, especially STI, can continue to huat because everyone huat, the economy will be better, everyone will be happier, and then we can have prosperity. So not just SG markets US market also huat, then all huat. Huat together, property huat, CPF huat, stock market huat, all what. But if you're a lower risk taker and you still not prepared to invest in market yet, maybe you can start to look at some fixed deposit rates. They are becoming quite attractive right now in my previous video right here.